The continued weakness of the Chinese market and the uncertainty surrounding European and U.S. equity valuations remain supportive factors for the gold market, says our guest today, Peter Hug. Peter, thanks so much for joining us on Kitco's Gold Report.
Yeah, it's nice to be here again, Daniela.
So you say deflationary forces continue to dominate the industrial metals complex. As you say, oil is a whisker away from posting a trade in the 20s. Looking to gold, you mentioned it will continue to catch a bid unless the equity markets stabilize here. Shouldn't gold really just be the best bet in town right now, Peter?
No, I think the problem with gold, it's being hurt by some of the other factors that are hurting the equity markets. I mean, everybody is selling everything. They're throwing the baby out with the bathwater. So you have major equity declines. China again overnight was down 6%. U.S. market again this morning after a short pop at the open is on its downtrend again. European equity markets are on a downtrend. Everybody seems to be moving into cash. And as a result of that, unfortunately, some of the people that are still holding positions are looking for liquidity. And so it's having somewhat of a double-edged sword impact on gold. You're getting selling of gold as people try to raise liquidity, but it's still finding a bid from a fear factor perspective. So you're getting two-sided trading on the gold market. I suggested a couple of days ago, this is a trader's market right now. It's extremely dangerous for investors.
Peter, what about silver? You know, rallies continue to fail time after time here, as we saw last Friday, and bullish spirits are really dampened. Is the slowdown in China manufacturing the culprit here when we're talking silver?
Well, silver has a component that's an industrial component to it, and if you look at copper that's trading now south of $2 a pound, again, oil at one point today broke down through 31. It's had a small rally since then. But silver is impacted from an industrial usage perspective, and the global economies are on a slow growth path right now. Chinese demand is way down. European growth is still anemic. So silver, from a perspective of an investment metal, with the industrial component attached to it, is not moving as briskly as gold would, and that's evidenced by the ratio. Normally with gold at these levels here, you could expect silver, even at a modest ratio of 75 to 1, to be trading somewhere around $15. But the ratio is approaching 80 to 1, and it's only been there 3 times in the history of the market that I've been involved with since the 70s. It's being influenced by the deflationary forces that are hurting all of the industrial metals.
And what about palladium? Once a star player, it was the worst performing precious metal for the week, falling over 12%. Is it a buy now?
Again, depending on your horizon, I think palladium anywhere under $500 is definitely a buy, but you're going to have to be patient. If auto demand, and I think we've hit peak sales in autos in the U.S., starts to slow in North America, you don't have the engine for that demand yet apparent in Europe, and certainly not in China. And palladium does have a significant usage from a catalytic converter perspective in the automobile industry. So if you're at peak auto sales in North America, there may still be some short-term softness in the palladium market, but certainly anywhere under $400, if you're prepared to hold 2 or 3 years, I don't think you'll go wrong with that investment.
Peter, thanks so much for your thoughts today. We'll see you next week.
Yeah, thank you. See you then.
And thanks for watching this edition of the Gold Report. We'll see you tomorrow.